Last week, the Federal Reserve cut the benchmark interest rate by a quarter point, but it actually made mortgage rates worse, not better. Well, why is that? Well, if you've seen any of my previous videos, you already know there's a difference from the benchmark interest rate, which the Federal Reserve controls, and mortgage rates, which are controlled by how investors react to what the Federal Reserve does. Now, because investors were already anticipating this rate cut, it didn't have a positive effect on rates because this cut was already baked into the mortgage rates months ago. What they were looking for during this meeting is they were looking to see what Jerome Powell, which is the head of the Federal Reserve, was going to say about rates next year and what their projections for next year are going to be. Well, he said that next year they anticipate fewer rate cuts than what they originally thought. And that's because the labor market still seems strong, the economy still seems strong, inflation is being stubborn, it's not going down. And in order for mortgage rates to come down, inflation needs to come down, and it's not. So that means bad news, rates might stay up for a little while. Good news is that there's less competition on the market. We just had a borrower who had their offer accepted because they were the only one who submitted the offer on the property. Well, what happens when rates drop? Everybody who's waiting is going to jump onto the scene, and now you're competing with 20, 30 other people for one house. You're having to overbid. It's going to be a nightmare. So my advice is get in your home now while you can, while there is less competition out there on the market. And then whenever the rates drop in the future, which they have to, it's inevitable, right? They can't stay like this forever. Then at that point, you refinance, you get your lower payment. Any other questions, let me know. And also let me know what you think about all this in the comments.